Good morning, ladies and gentlemen. My name is Adisha Naidu. I'm from Standard Bank Global Markets Retail Investments. I'm joined once again by Tom Gale, Executive Global Markets, Standard Bank Trading. Tom, thanks for this morning. Looking forward to today. How are you doing?
Good. Thank you, Addy. Thanks for having me.
As always, Tom, we've become quite a avid celebrity among the base, and the insights you bring are very valuable to our team and to our clients. A lot of news this weekend. Biggest talking point is the US and the joining of Israel in bombing Iran. We've got it grouped together as geopolitical tensions, but can you unpack this?
Yeah, sure. Look, first of all, thank you again for having me. And as much as we have some sort of insight here in global markets, the trading floor at Standard Bank,
Mhm.
we don't have all the answers. If we did, we would have retired a long time ago. Um, so, what I can distill, and I would hope to distill for your audience, are the views of a number of industry experts. I might talk to our commodity forecast. I might talk to the stocks that we like or don't like, and I'll certainly talk to what we feel is a trading floor of the way that markets are navigating a particularly difficult period in history. The other thing, just to correct you, you said that Israel joined the bombing of Iran. I think let's just be clear for everyone's benefit that it was Israel that was bombing Iran
Yeah.
through last week. And I just want to be clear that the big development at the weekend was that the US participated in some of the bombing raids. We had been on alert for this last week because the language from Trump became more bellicose, and there was, we understood as markets, going to be a 2-week deliberation by the US administration as to whether they would join Israeli military action. Well, in the end, that was something of a decoy. We can talk to that in a moment. But I just want to be clear that it is a momentous occasion that the US takes part in these raids. First of all, because it's tantamount to an escalation. This is no longer a regional conflict; it's now a global conflict. There could be repercussions for the US, and of course, many people have pointed out, not least in Trump's MAGA base, that he was voted into the White House on a ticket of isolationism. That is to say that the US would not involve itself in global conflict. And so this has caused some ruptures, as I say, amongst Trump's base. And I think we're going to continue to see this. At the moment, the military authorities, at least in the US, have made it clear that they're not looking for anything beyond precision, what they would consider to be precision bombing of these underground nuclear facilities at Fordow and so on in Iran. Typically, covert nuclear work will be housed in a place that is safe from attack. And it is certainly the case that Israel did not have the capability, the military capability to strike deep beneath a mountain, as was the case with this Fordo military um, uh, military base under the mountain. So the US had the capability. They had this bunker busting capability that was used. It remains to be seen what comes of all of this, whether it has been a good or indeed effective strike, or whether the Iranian authorities were able to move their near weapons grade enriched uranium somewhere else, in which case they will now be pursuing rapidly the full enrichment of that uranium, um, uh, or whether indeed Trump has bigger ambitions which would further roil his base, and that is for regime change. And he has alluded to that on his social media posts, and that would also represent a big departure, and again would then mean that he's not isolationist, but he's doing what previous U.S. administrations have done. So This is a momentous occasion, and we really will not understand the full implications of this for some time, but it is certainly accurate and fair to say that geopolitical tension has now ratcheted up significantly.
Well, I mean, that's all that's said and done, but I mean, this then ties into a lot of what's going on. I mean, we've got upcoming US. We had the Fed last week, or with the US Fed last week. There's talks there. I mean, this impacts markets. This impacts. I mean, point two. This impacts a lot of what the US is central to a lot of these points. So I mean, as you said, it's at an all-time high, but then there's underlying or under there's issues and under that underpin this at the bottom.
Well, okay, let's just think about this for a moment. So what we're seeing in markets this morning, after those weekend US military strikes, is actually markets behaving fairly well. There's the inevitable rally in oil prices, uh, and that you would expect, of
Mm,
course, given that Iran controls not only its own big oil reserves, but it
mm,
also can choke a key shipment point of oil tankers around the world, and that is the Strait of Hormuz.
mhm,
And they've threatened intervention there to close that off to something like a quarter of the world's oil traffic. So oil prices will be higher. Of course, they will. If it wasn't for this round of geopolitical tension, oil would be lower. We feel very confident about that. In fact, in previous sessions, Adi, you and I had talked about our feeling that oil should be heading towards $50 a barrel, and it
mhm,
will in time. It will. The chart I'm sharing now shows where oil has rallied to. So from somewhere around $65 a barrel up to 77, and that's a big jump in oil prices. But I also just want to make the point that it's only at $78 a barrel, 77, $78 a barrel. So it's still below recent peaks. Last year through $80, previous Ukraine-Russia conflict
mm,
saw the oil price above $80. And the other thing I would say is that we call the curve in backwardation, and that is to say that if you want oil for August delivery, you're going to pay more for that oil per barrel than if you want oil for, let's say, October delivery. So October prices are slightly lower, and that's what we talk about a curve being in backwardation. So what that tells us is that the concerns in the oil market are for near delivery. And that probably speaks to this concern that shipping could be disruptive around the Strait of Hormuz. But beyond that, there remains a broader concern, which is higher oil prices are not good for either economic growth nor inflation. And I think that that's an important consideration at this point if we're trying to think through the implications of oil here. If I could just add another point, which relates to the markets behaving quite well this morning. Equities performing okay in Asia and here on the JSE right now. Um, and most indicators that we look at looking okay, no panic from investors, and indeed oil only being at 77 or $78 a barrel, is that markets feel for now that they can navigate this geopolitical tension. We'll see. We remain concerned, and I mentioned this before, that there's event risk that is clustered next month, July onwards. In particular, just to remind you, the lifting of the moratorium on global tariffs, even those countries that have done trade deals with the US are still subject to a higher baseline tariff for US imports. And so this will be friction on global trade and therefore on global growth. Also in July, certainly ahead of the August US Congress recess, US will need to deal with its debt ceiling because that's exhausted. And if they're to see through the one big beautiful tax bill of Donald Trump, they're going to need to find at least another $2 or $3 trillion of debt headroom. And we think that that poses greater risk to markets, or at least it's risk that is going to have to be navigated very deftly by markets. So we're more concerned with that for now. But this is a very fluid situation right now. If we can, I would like just to get back to the point about oil being higher.
mm,
Normally, when oil's higher, it's going to cause a little bit of inflation down the road. We're all going to
mhm,
pay higher prices at the petrol pump. And there's what central bankers would consider to be a secondary risk of inflation, and that is oil knocking on to other prices, goods that are more expensive to make because of the oil component, and of course expectations that inflation will be higher. So inflation becomes a little stickier when oil goes up. Normally then what you would see is the market doing an about turn on rate cuts and saying, well, if oil's higher, there aren't going to be rate cuts. But what I'm showing you here, forgive me for a busy slide, but I want to draw your attention to the column that says including drift, because these are the numbers that the market is pricing this morning in terms of rate cuts for South Africa. And you can see in the second row, rate swaps are showing 16.5 basis points of rate cuts still to come between July's meeting and the following meeting. And if you follow that column down, follow it down, you'll see that we're going to get at least one more rate cut of 25 basis points. So our rates probability will tell us. The next column along is US rate cuts. And here you can see that, well, the market's very excited about there being at least 2 more rate cuts. So oil so far has not interfered with that. And this is the point that I make about fears around global growth. We're all familiar with growth problems in South Africa. And we've got very high real rates here. Our rates less inflation are some of the highest in the world, and we have room to cut. So still it remains the case so far that markets are not concerned about losing the rate cuts. Now, I'm going to come on in a minute to talk about commodities and our product suite. But I wonder, should you and I just mention the Rand for a moment?
I think that would be very important to the audience.
Yes. So the Rand's a funny thing. And again, you may recall some of our previous conversations.
Yep.
That we here in the trading room have certainly concluded over recent months, and in fact for more than a year now, that the Rand is less volatile than it used to be. And some of your listeners, your audience may be surprised to hear that. We do, of course, remain far more vulnerable to global headlines than some developed market currencies. But the way our currency behaves these days is less volatile than it used to be. Our economist is concerned about the impact of higher oil prices on our current account. It means that we're having to buy more oil, import more oil at higher prices, at least pay more, I should say, pay more for oil imports. And that will cost us more dollars, you see. So whilst we have high gold prices, we've had high platinum group metals prices where dollars come into the country, higher oil means that dollars go out of the country. And that's a concern for the current account, and therefore it should be a concern for the Rand. And yet the Rand has been very steady. We do think in the short term there are risks to 1845, 1850, and we're on alert for that. However, we still stick with a core view that the Rand will continue to strengthen very gradually. And so if there's risk in the near term, of an escalation, of Trump wanting regime change in Iran, of there being retaliation from Iran, and so on, then we might see the Rand to 1845. But as things de-escalate and normalize, the Rand could get back to 1750. So in time, we remain married to the view that the Rand will continue to gradually strengthen. Okay. Now, I think I've also mentioned in the past that in global markets here, we are particularly interested in commodities.
Yep, you have in previous times.
Okay.
I think we've leaned to a few here and there, and I know that obviously oil does fall part of this, but yeah, I think there's a bigger story to commodities than just oil.
Well, there is, but if we're talking about oil, most of your listeners will be aware that Sasol would be the biggest beneficiary, of course, of the oil price going higher. Our research analyst has a very bullish view on the long-term outlook for Sasol. And we have a price target that's somewhere around 400 rand a share. So that's one, if you really believe that oil's going higher, that you could buy. As I said earlier, we think that the longer term outlook for oil is lower, at least for the time being. Once we move past geopolitical tensions, the immediate geopolitical tensions, we will fall back to about low $60, and eventually we could be as low as $50 a barrel because global growth is slowing.
Mm-hmm.
Right now, with the oil price elevated, that's not great news for the consumer, and so that will put a bit of pressure on retail stocks. We like retail stocks. They're showing value right now. And I think I've mentioned previously that we have a preference, for example, for Sheeny and for Mr. Price and one or two others, but they will struggle in an environment where oil price is higher for obvious reasons. If you therefore prefer to trade the commodities on the JSE, and you'll have access to these instruments through your online share trading account, then you can trade our ETFs. And your audience may now be somewhat familiar with our product offering. We have ETFs, exchange traded funds, that hold physical metal. You will effectively buy a certificate that gives you recourse to a physical metal. For gold, that would be ETF GLD, and for platinum, ETF PLT, and so on. We are looking to build out this product suite in time, but it's quite a lot of legal work that needs to be done, and we have been looking at silver, and we may consider that again down the line. Also for some other PGM metals, ruthenium has popped up in a lot of conversations. Palladium and rhodium form part of our current suite of product. As I say, these are all available to trade through your online share trading account. Gold is a favorite, remains a favorite topic of discussion, and also core positions for our institutional portfolio managers. And I just want to draw your attention, remind you that we closed the book on our gold miners auto call, I think at the end of this week, Addy?
Yeah, we close on the 26th.
Okay, well then, just to remind your audience, this is very interesting payoff profile on the VanEck Gold Miners ETF. This is an auto call which will pay a coupon annually if this index, the VanEck Gold Miners ETF, is either flat or positive over a 3-year period. Now, you have to observe certain observation dates along the way, okay, to collect those coupons. But the nice thing about this is if you don't, your capital is protected down to a trigger level.
Yes.
Okay, and I would urge your audience just to check with your colleagues, Addy, for a little bit more information on this. But it would be very nice to take some coupons based on some guaranteed coupons based on those observation dates, as I say.
No, 100%. And I mean, to your point, it's a very good product to have in your portfolio, and gives you that exposure to gold. And yeah, it is available to the client on online share trading. I think for those that do not have OST accounts, and they are at other broker houses, should they be listening in, we do have relationships as well. So your broker house can reach out to us as well.
Okay. Thanks, Addy. And I just want to finish on one last reminder, which is that we're not limited to ETFs for our commodities offering. Your audience can also trade oil and copper via JSE listed instruments. Now, the problem with these two commodities is it's very difficult for us to hold the physical as an underlying. So, for example, on our ETF gold, we hold gold to back the certificate, and that gold sits in a vault in London. But it's a bit more difficult to do that with oil and with copper, which are much bulkier. And so for these two, we reference an underlying future, a futures contract, which does itself roll from near dated to the next near dated. And that does involve some costs, some slippage, or you can gain from this potentially. But the point is that you take the roll risk on these instruments. But nevertheless, they are very low cost ways to play exposure to oil, Brent crude, and to copper. And you can find these listed on the JSE under the tickers SB Oil, SB Cop.
Well, I think, Tom, that wraps it up for today, if I'm not mistaken. Well, thank you so much, Tom. And to the listeners out there, we'll touch base again next week. Thanks, Tom.
Thank you.